Look around today and you'll find many people calling AI a bubble. But what if what's actually happening beneath the surface isn't a bubble, but something far bigger? Because right now, most investors are on the wrong side of the biggest market shift in decades, one which can either make you or cost you a lot of money. So, why are things feeling so much like a bubble? I get it. Nvidia's up more than 100% already since April. Microsoft, Apple, Amazon, all near record highs. Mag 7 now makes up over 30% of the S&P 500. Concentration this high definitely feels unstable. And it feels like the dot-com bubble may be upon us soon again. Add to that recently all these blockbuster deals that you see. There seems to be the rise of circular financing. While many of these companies are funding each other's growth, Nvidia invests in AI startups buy Nvidia chips. Revenue numbers go up, investors get more excited, and the cycle repeats. Well, just look at this chart that's been circulating online. It looks like a whole spider web of arrows and logos going in every direction. It's so intertwined that at first glance, it just feels like something isn't right. It almost feels like the sole purpose of this chart is to confuse investors, hoping they don't realize a bubble is actually forming. Well, it's easy to point to all these and call it a bubble, because it does feel like one. But do you want to make important investment decisions based on mere feelings and people's opinions? I don't think so. So let's look deeper at some hard data and facts, and you will see what's really happening beneath the surface. So, what's different this time? Now, to know if the current market is in a bubble, it only makes sense to use actual market metrics. Let's look at the famous price-earnings ratio that all serious investors look at. Back in 1999, right before the dot-com bubble popped, the biggest tech companies traded at almost 70 times earnings. Today, only 37 times, barely half of that. Yes, valuations have grown steadily and are rich now, but we are nowhere near bubble level right now. PE is so important because it's basically the hope ratio, arguably the single most important metric that shows whether or not we are actually in a bubble. Think of it as the price the market is willing to give companies based on how their current earnings outlook look like. It's optimism that the market is placing on a company's future earnings. The higher the PE ratio, the higher the market expectations for growth and the more hope there is. That's why it's such an important metric. Because a bubble only forms when there's excessive hope and hype priced in. And right now, we can see that this hope is not excessive. And what's driving a lot of the high stock prices today is not the excessive hope, but super strong earnings. You may ask, is the market too naive then in thinking that this strong earnings growth will continue forever? Here's what most people miss. Today's market implied long-term growth expectations sit only modestly above the average, around 10% versus the 9% long-term trend. That's not euphoria, that's cautious optimism. And if you don't believe me still, let's look at the Fear Greed Index. Does a reading of 56 look euphoric to you? It definitely doesn't to me. Now many say that concentration risk is too high, that everything is in the Mag 7. But again, that's not new. Every era has seen its dominant firms leading the defining technology of their time. The names change, as you can see, but the pattern doesn't. So, the market behavior feels frothy, but the actual data says otherwise. So is there no risk to this AI trade currently? And if there is, where is it? Well, the risk is that you are too focused on watching this video currently that you forgot to give this video a thumbs up and subscribe. Well, just kidding. But if you've watched this far, you probably care about investing beyond the hype. I've only been creating content for a month, but I'm confident that you'll find value here. I don't put any content behind a paywall, but all I hope is you can give it a like, a subscribe, share them with your investing friends, and grow with me on this YouTube journey. If you are serious about investing, I guarantee that you won't be disappointed. I'm not sure how long I will stay on YouTube as my real life work gets busier, but your support will definitely give me the added motivation to continue to bring you guys quality content for as long as I can. Now, as promised, let's talk about where the real risk lies. What history tells us is that while the market always survives, individual companies may not. Who's winning today might not be the winner of the next decade. While valuations definitely aren't bubble level right now, a fall in earnings will still destroy individual stock prices, as assuming the P ratio stay the same, when E, the earnings drop, P, which is the price, would have to drop as well. This is where the real risk lies, individual companies crashing. AI capital spending is now approaching a whopping $400 billion a year, led by semicon, hardware and data infrastructure. But not every dollar will translate into profits. Right now, the builders are winning, the companies selling the picks and shovels for the AI boom. And at the same time, the hyperscalers and the cloud giants pouring money into this training may be under a bit more pressure. But you know what? Everyone loves to repeat. In a gold rush, sell shovels. But let's be real, gold's at $4,000 right now. Is anyone still talking about shovel companies? The trade always shifts. Right now, AI CapEx, data centers, they are the hot thing. But nothing stays hot forever. A lot of companies are investing so much in AI today, not because they already know exactly what to do with these investments. They are investing because if they don't, they'll fall behind, and they know that AI tech will only become more revolutionary, such that if they fall behind, they will eventually die. That's why AI CapEx right now feels like a race for survival. But once it becomes clear who is going to survive and who is not, there is likely going to be a huge change to what companies will spend on in terms of AI development. And it's likely going to be less on CapEx anymore, but more monetization. So what's the game plan now for us investors? We know that the overall market right now is healthy and not bubbly, and there's still huge potential for AI. But some individual companies and sectors may suffer huge correction if it becomes clear that they are not going to be the winners in AI. So unless you have access to in-depth research that no one has to all these companies, why gamble on stock picking and trying to predict who will be the companies that survive and thrive? Institutions that are dedicating full-time resources in the billions on fundamental stock research, and even then, they still get it wrong sometimes. That's why, for us, just own the market, just own the tech sector, or at least a diversified basket of AI names across the value chain. Sometimes the smartest edge is really not to overplay it. And that's because going forward, it's not going to be all just good news. Corporate AI adoption has already slowed in recent quarters. This drop shows that adoption momentum has cooled, and when it does cool more, I can guarantee you that the media will come out producing crash headlines and more people will tell you that the bubble is popping. But please remember, that's not collapse. Check the P ratios, check the fear-greed indexes for yourself, and don't just blindly listen to everyone around you when the time comes. And don't hold individual companies you are not sure about. This is exactly what happens every time a new technology starts to diffuse through society. AI's productivity boom will come, but it will take time. Every major innovation, as you can see, from the electric motor to the internet, follows the same curve. A few years of heavy investment before the productivity gains truly start to take off. Gen AI, or AI in general, is going to track that same pattern. And right now, we are still early. So, after analyzing all the hard data and facts, I hope you have come to the same conclusion as me. And that is, no, the AI currently is not in a bubble. It's a capital cycle, real earnings, real innovation, in a market that will continue to grow as a whole, but with very real risks to individual companies who don't come out ahead. If you're only watching the surface level talk in the media, you miss where the real opportunity is. If this helped you see the market differently, hit subscribe because I explain what the markets are really doing, not what it looks like it's doing. Hope you enjoyed this and see you in the next one.